and welcome to the Standard Bank Trade Table. Joining me in studio are my esteemed guests, Kobus Volschenk, Chief Operating Officer at Motus Retail, Milo, Executive Head of Trade for South Africa, Zahida Simjee, Executive Client Solutions in Global Markets, and Musa, Hlanti, Executive Head of Trade Sales for South Africa. Welcome everyone and thank you so much for joining me. What a year it's been. From trade tensions to tariff hikes, more than 90 countries globally will be impacted by the recent US tariff hikes. South Africa is one of 11 countries that will be impacted by tariff hikes of 30% and more. The world is changing and the world is changing rapidly. At the heart of our discussion today is how does South Africa position itself amidst these uncertain times? And how do South African businesses thrive commercially under an environment that is characterized by tariff hikes, supply chain disruptions, and rand volatility? On that note, we officially open our discussion today. We officially open the trade table with Mr. Milo. Over to you, Justin.
Thank you very much, Nompilo. And first of all, I'd like to welcome and thank all of our customers for joining us online for this very important conversation. In terms of today's discussions, we'll be looking at how we can navigate some of the complexities, risks, and challenges which have come about as a result of the implementation of tariffs by the US. Now, this conversation will have particular relevance to South African exporters, as well as those who support export value chains within the South African economy. But in addition to that, there's national interest in this conversation because any adverse impacts on the South African export sector will naturally have a ripple effect into the broader South African economy and result in adverse impacts in terms of economic output and employment. If you look at some of the risks and challenges that South African exporters face, of course they face the challenge of reduced sales into the US market, and this is a risk that a lot of countries around the world will indeed face. But in addition to this, South African exporters will face financial market volatility whenever there is a new announcement around trade tariffs, or indeed when there's certain country responses to these particular tariffs. What's also very important to highlight is that there is a growing need, or there will be a growing need for liquidity as South African exporters look to find new markets as well as to adapt their business models to the new trading realities that they face. Now, in light of this, diversification is key, and it's going to be vital for South African exporters to diversify and to find new markets. However, the challenge that they'll face is that diversification takes time. It takes time to find new markets, to find new customers, to learn new regulations, and to negotiate new contracts with their customers. But even more important than this is that diversification comes with risks, complexities, and challenges. And in terms of today's discussion, it will be on navigating these risks, complexities, and challenges. So the way I like to look at this is that it's at times like these, or times like this, that our customers need us the most, and we really are here to support you. So I really hope that you enjoy the discussion today. I hope you find it insightful and interesting. And there will be a Q&A section. Please do drop any questions that you have into the Q&A box, and towards the end of the discussion, I'll help to facilitate some of your burning questions. Thanks a lot, Nompilo. Back to you.
Thank you, Justin. Zahida, I'd like us to take a step back. There's been a lot of newspaper articles, thought leadership paper articles, research paper articles written on the tariffs, and lots of discussions around it. But I wanted to take a bit of a step back. When countries speak about the US tariffs, what is the impact of those countries that are implementing these tariffs, and what is the impact to their trading partners? Perhaps if you can give us a short-term view and also a long-term view.
Thanks, Nompilo. So US companies are liable for these tariffs, and they will be faced with three decisions. One, absorb the costs, and this will impact their profitability. Two is push back on their suppliers, and this is limited to the extent that they are able to do so, switch suppliers internationally, or potentially look at switching to local or domestic suppliers. And the third is to pass on the tariffs to their clients. And this will drive up prices. So it's not always an easy decision. And often it's a combination of all three. Of course, switching to domestic suppliers will be something that is more longer term than shorter term. Now, the aim of the Trump US tariffs was to protect American interests, to drive local production, and to look at reducing the trade deficit. The reality, unfortunately, is that tariffs are a tax, and it will lead to higher prices, driving up inflation. It will definitely put pressure on jobs in an already pressurized market where you have an escalation of innovation in the AI space, and it will certainly curtail growth in the long run. So tariffs will impact the GDP. It's expected that US GDP will probably fall by 0.3% in terms of the tariffs. Now, economists have also warned that there's a risk to stagflation, which is stagnant growth and higher prices. When we look at this from a more global context, we look at the IMF looking at GDP of about 3% softer in 2025 and 3.1% in next year, in 2026. Now, this is down from 2024 real GDP of 3.3%. When you look at the trade partners, what you can say is that tariffs are not a zero-sum game. It's all about relative competitiveness. And partners that are able to switch trading lines faster and trading partners faster may cushion some of that impact. And as this all plays out, we'll watch it very closely.
Wow, very, very interesting, Zahida. And maybe if we leverage off what Zahida has said, Musa, we are on the eve of these tariff hikes being implemented in South Africa. And a tariff of 30% could wipe away 100,000 jobs and also shave off 0.2% of GDP growth. Now, that is massive for an economy that is not growing very fast. Musa, maybe what are some of the sectors that can be impacted by these tariff hikes within the South African economy?
No, thanks, Nompilo, and thanks for having me. I think this tariff will severely impact our very important and strategic sectors, namely the automotive sector, the agri sector, and to less of an extent, the aluminium and also steel sectors. If we break it down to those three impacted sectors, we do believe that the automotive sector, including the component exports, will be largely more impacted than the other sectors. In terms of the auto sector, the major OEMs, the likes of your Ford, BMW, also Mercedes, are currently, as everyone else, assessing their export strategies into the US. But in order to put it in context, if you look at South African vehicle exports to the US in 2024, the contribution of those exports was roughly 6.5% of all total vehicle exports, which is worth roughly $1.8 billion. Now, what this tariff then does, and the impact of it, is that it threatens a couple of key things, and there's certain key considerations when you consider it. One is that this particular tariff on the auto sector will impact our clients or exporters' profit margins, which will directly export to the US. And that's on the back of obviously the US importers or buyers effectively pushing back on price increases. The second component or the impact is the supply chain stability within the local manufacturing, sector in autos, which is more important and more impactful in terms of the component suppliers, in terms of the OEM supply chains. So when I say OEM component suppliers, I mean the guys that provide your harnesses, your wiring, etc. As these are largely smaller suppliers and largely are low base business and effectively depend on economies of scale. So if they can't supply to the OEMs, or they then effectively have to supply less number of OEMs, you can just imagine the impact. I think another component which is incredibly important is the impact on the long-term investment on our local manufacturing. In particular, if you look at East London, likes of Gqeberha and also Pretoria, for the OEMs, it will have a long-term negative impact because there won't necessarily be further investment in those manufacturing plants in those particular provinces. And for me, lastly, which is I think the most important and impactful consequence of the tariff, is the employment piece, which is especially in the Eastern Cape region, which ultimately also has a multiplier effect, considering the stats that, for example, for one job, that one job actually supports 5 family members. So that is going to hit the job numbers in SA, which we already have a very high unemployment rate. If you look at the agri sector, for example, the most impacted subsectors is the citrus subsector, the macadamia nuts, and also the wine industry, which historically has always benefited largely from AGOA. The citrus exports in particular at the moment represent 5 to 6% of total exports to the US, generating over $100 million annually and supporting over 35,000 jobs. And reading and listening to the Citrus Growers Association, they've effectively came out and said there's going to be huge negative impacts in terms of profitability, and also similar to the auto sector, massive job losses, in particular in the Western Cape. And the macadamia nuts and also wine exports also face a similar risk as well.
Thank you, Musa. Kobus, the automotive industry is coming up time and time again. There's an impact of about 35 billion should these tariffs come into effect. What are some of the short-term effects that we can see on the ground?
Peter, good morning, and to all those joining, thank you for having me as well. I mean, maybe to start, I think President Trump has announced the 30% that will go live in a few days, we think. But it's the type of topic we're discussing today that you almost have to check your news feed before you answer any question, because you just don't know what's coming. There's obviously the additional benefit of being a member of BRICS and the 10% that's being threatened. So there is no doubt that, as Musa has alluded to, that OEMs as a business have to consider their position, and they're definitely doing that. I mean, I don't think any business we can expect that they won't be actively engaging in these types of topics and understanding the risk of tariffs. So industry bodies tell us that the exports in 2024 were lower, and as Musa has quoted the stat of 6.5% of our export volume that went to the US. It's in the context, it's about 3.5% of total vehicle production in South Africa. So, you know, it sounds a lot in 20,000 vehicles, but maybe the impact is even larger in the component space. And earlier this week in Business Tech, there was an article about a smaller business, Gendermark was quoted, of not being able to participate in tenders of 750 million rand. Now you can imagine, for a business of that size in a town like Gqeberha that Musa also referred to, it is substantial, and all the livelihoods that go with that. So I think it's something that one has to almost watch more carefully in the component space. BMW has publicly said that there's high enough demand for what they're producing in South Africa for other markets to pick that up. And they're not looking at solving in the short term for the US. As Motus, we're not so much in the export space. I think it's the ancillary impacts which are indirect. I think there's been reference to the impact on currency. Those of you who can think back and remember Liberation Day and the spike in currency for an importer of any nature, not just ours, that is probably the worst situation you can find yourself in. And I think that we I think for us as vehicle retailers, the ability by the OEMs to continue to supply competitively priced vehicles for the consumer is probably more important even than the impact of the tariff directly.
Wow. And to your point, we did start to see a scaling back in 2024 already, when there were still murmurs and discussions on this topic. So, Musa, these are turbulent times. How does South Africa balance its traditional relationships with the US and the EU, excuse me, together with its new alliances like the BRICS, and also just the threatening of the increasing of the 10% tariff hikes? How can we balance our relationship as South Africa?
That's a very good question, Nompilo. I think the US is still one of our key and largest trading partners, and we don't see that necessarily changing. And that's effectively the same for the EU as well as a trade and investment partner. Therefore, I think as a start, it is still extremely critical that SA negotiate in terms of the bilateral network framework between the US and SA. And also, in that same breath, looks to negotiate better terms with the EU via the economic partnership agreements, the EPAs. However, there is a particular green shoot from a BRICS perspective, especially BRICS in its expanded format, now including the likes of the UAE, Egypt, Ethiopia, and others, which also offer a new trade and investment opportunities, in particular, access to large consumer markets for the likes of China and also India. And funny enough, I was also similar to Kobus reading the news, and I saw an article around China also looking at potentially imposing free duties on African imports by Chinese companies, which could obviously change the tide and promote investment and export into China. But that is still relatively far ahead, and that's still being negotiated. I think lastly, there is a huge opportunity for the Africa Free Trade Area or Africa Free Trade Agreement, which presents an opportunity in terms of intra-Africa trade. And in particular, the auto sector, where we've seen the African population growing in numbers and is predicted to become one of the largest population areas in the world in the next couple of 5 years. There's increasing disposable income that's available to the African population, and there's also upward mobility in terms of affordability to actually spend on things such as vehicles. Obviously, the Africa Free Trade Agreement still has some lingering issues that will still need to be effectively ironed out, including dealing with infrastructure, customs procedures, which will then promote free access, but also the political will of those particular countries to promote the Africa Free Trade Agreement areas as well.
And perhaps to leverage off BRICS, Kobus, what are some of the markets that the automotive industry can export to, and can we look to BRICS for some of these market opportunities?
Yeah, thanks, Nompilo. I think it's well known that Brazil, China, and India have well-established vehicle manufacturing capabilities. So we probably have less opportunity into the traditional BRICS bloc. I think there are probably two major opportunities. Africa, which one must just remember that the size of the markets in Africa for new vehicles are much smaller than what we are used to, and definitely in Sub-Saharan Africa is much smaller than what we used to here in South Africa. Partially pricing, affordability, and the other side obviously is the import of used vehicles are allowed in those countries, which we are not used to here in South Africa. The EU probably remains, I think, as Musa alluded to, one of the big opportunities for us. I think all our trade negotiations we're doing alongside our Southern Africa Customs Union partners of Swaziland, Lesotho, Botswana, and I almost said Nambia, Nompilo, based on the topic, but Namibia. And I think it's important that we as a bloc continue those negotiations. But SACU today already has free trade into the 27 countries in the EU, Great Britain, and the European Free Trade Association, which covers another 4 countries in that area. And a number of our vehicle manufacturers in South Africa are already exporting to Europe and will continue to do so. If we maybe just look a bit at Africa, and the African Union is obviously established and driving the African Continental Free Trade Association, and the trade growth they're looking at is more than 53%. Now, if you look at 53%, you would imagine that that must uplift also the auto sector. And if it is not in autos directly, it must include components more broadly, especially if their estimates of the GDP growth by 2035 will be up to $450 billion. I can imagine that must be a good opportunity for us to realign our thinking. But it is also monumental if that bloc can work in unison. On the world stage, which I think is also something that Musa alluded to as a younger population and a buying bloc. The one bridge, no pun intended, to cross is obviously our infrastructure. That is a bit of a hamper when one looks at Southern Africa. I think we have 16 countries that are landlocked, which is probably one of the areas that hampers their own growth, and that needs to be bridged. And they then look at their partners who have a coastline, where we need modern ports, reliable rail and road infrastructure, and then advanced airports available to secure that. But do I think that Africa can be an opportunity, and do I think that it will be able to uplift us in our drive? Yes, I do think so, and I think those that are actively looking at this in the automotive sector will continue to investigate Africa.
Understood. So EU remains strategic. BRICS and the African markets remain some of the growth opportunities that we can look to there, Kobus. So the Rand came under a lot of pressure on Friday, reaching some of its weakest levels since May 2025. Zahida, could the imminent tariff hikes and also the broader global tensions have an impact on the volatility of the Rand to the dollar, especially against major currencies such as the dollar?
I mean, the dollar has always been considered the safe haven asset of the world. So during bouts of uncertainty and volatility, we see a flight to the US dollar and US treasuries. Now that changes the game when US trade policy is uncertain. What we've seen year to date is that the dollar index has declined 10% from the beginning of the year to approximately end of July. And so what this means is that instead of the dollar being a safe haven asset, you've now got uncertainty on the dollar. When all major commodities such as oil and gold are priced against the dollar, there ends up being a concern. So there's market instability and uncertainty. And so what you see when news comes out, the market either reacts or overreacts to that news or that data release. And so when you look at particularly the Rand opened the year at sort of highs in January of 1884 and settled towards the end of July, beginning of August, end of July, to around 1796 level. It's slightly stronger on the day-to-day, but that's approximately a 4.5% year-to-date strengthening of the Rand. Now, in that, the Rand has also seen its weakest level year-to-date in April, which it saw it go up to 19.93. And then just in July, we had the dollar-Rand year lows of 17.50. So now that's a 2 Rand 43 swing in dollar-Rand. And in April, 1 month realized volatility shot up to 19%. And it was driven by both global factors as well as local factors. So we had the GNU tensions quite topical at that point in time. And you've got geopolitics playing out at that point in time, as well as tariff noise. So now currently 1 month realized volatility has clawed back and settled down, is in much more subdued at about 11% in terms of 1 month historical realized volatility in the dollar rand. And you see that when the rand is weaker, volatility is higher, and when the rand is slightly stronger, volatility is lower. Now, it's difficult to isolate the actual impact of just tariffs, given how nuanced it is relative to all the other factors in play. What we can do is look at the rand against its peer currencies. So where the rand strengthened year to date at 4.5%, we see the likes of the Brazilian real strengthening over 11%, up to almost 12% year to date. The Mexican peso 9%. And Malaysian currency strengthening almost 5.5% to 6%. So the rand actually underperformed relative to its peers. But there are some emerging market currencies that performed worse than the rand, like the Indian rupee, which actually was down year on year. Down year to date. So when economists look at the fair value of the rand, they definitely factor in the terms of trade. That's sort of the key input into the fair value of the currency. So on a trade-weighted basis, they really do expect limited rand gains at this point in time. So their expectation is that the rand actually settles year-end at 1785. Now, that doesn't mean the rand can't go to a low 17 level. It just means on average, they expect the rand to hover around the 1805 level, and for the upside in the rand or dollar rand lower to be quite limited. Now, that's maybe slightly contrasted by what the traders are seeing at the moment. The traders are seeing sort of a lower interest rate differential. They're seeing, looking at the MPC last week and seeing rate cuts coming in and factoring those. And they're saying, well, actually, the rand could have legs to grow even lower. So what this does sort of give you is a sense of the uncertainty in this environment, given the lack of predictability and firm economic policy in this market.
And perhaps to continue and add on to that question, could we look at rand-denominated trade for BRICS? Is that something that we could look at in terms of opportunities?
Okay, so, maybe answered slightly differently in terms of could we look at rand-denominated trade is important to highlight the opportunity to almost diversify one's currency risk away from the dollar potentially and look at other markets and currencies such as the euro as our biggest trade partner alongside the renminbi, and China being our other largest trade partners. So switching your currency risk into euro, Aussie dollar, pound, as well as renminbi may offer an opportunity if you can negotiate that with your trade partners and where it makes sense in those markets to do so. I guess this is a very volatile, changing landscape, and there's definitely impetus for us now to look at alternative currencies and to point out that a lot of the hedging solutions that you find in dollar rand, you find in these crosses. So there's availability of risk mitigation in some of these currencies. Now, when you look at what happened across the continent, when there's periods of low dollar liquidity or low availability of foreign currency, what you often find is that it works well to sort of diversify some of your risk into euros, pounds, and renminbi. It doesn't alleviate access to foreign currency, but what it does allow one to do is diversify, and where there's opportunity, monetize on that opportunity. Now, when it comes to the renminbi in particular, there might be even an economic argument for switching into the renminbi. And this you need to really unpack and unlock with your trading partners, where there is a sense of renminbi value that can be derived by switching your invoices, both for importers and where you can from an export perspective, if some of those markets allow you to. And so definitely diversifying your exposure to alleviate some of the pressure that you find.
So I'm hearing a common theme of diversification, looking at other markets, looking at other currencies. On Friday, our president came out to say that the government is working on certain initiatives to assist exporters, particularly in the automotive industries. This was possible tax incentives and possible markets to export to. So Musa, how do these tariff hikes directly impact the cost to the exporters? And are these costs passed on? Are they absorbed by the exporters? Perhaps touch on that.
Thanks, Nompilo. So the direct costs in terms of these US tariffs are well ventilated in the market. So there's costs in terms of reduced margins as US buyers demand price reductions or negotiate prices down. There is potential direct costs in terms of logistical costs that exporters potentially will incur if they are looking at alternative markets and rerouting their shipments. And there's also a compliance component to that in the new markets. And then there's also the component in terms of renegotiation of contracts with your buyers in the US as an exporter. Now, the question around how are these costs being managed, either absorbed or passed on, is two different models. So if we start with the first one in terms of the cost absorption model that we are seeing the larger firms such as your OEM, adopting, especially in order to maintain their market share in the US market. And some of these, call it strategies that they're applying to absorb these costs is cutting internal costs, potentially delaying capital expenditure in terms of manufacturing or investing in manufacturing, and also taking a direct hit in terms of reducing profits. However, we see this strategy as not sustainable, and it is a measure that will potentially only last for 6 to 12 months, especially considering the impact to the smaller, call it supplier based on the supply chain impact. The second option, which is the pass-through, which many exporters, in particular the smaller exporters in the likes of your agri sector are trying to adopt, is passing on those costs directly to the US buyers. But inadvertently, what this results in is that there's potential reduced competitiveness in terms of your product to the US customer base. However, I think it's also important to put it in context, considering that the US tariffs haven't only been applied to SA. There's also other jurisdictions and countries where the tariffs have been imposed on. So it does not naturally mean that South Africa will always be uncompetitive when it comes to exports into the US. It will just depend in terms of what other options does that particular US consumer have. For example, if we look at the citrus market, the alternatives is particularly maybe Chile and Peru, where the tariffs for citrus is around 10% compared to the 25% that's been imposed. I think another impact in terms of looking at passing through costs to the end consumer is the lower sales volumes that will naturally occur as well. And then also, I think ultimately the risk of losing long-term contracts. And therefore, sectors, as I said, like in the macadamia, the nuts and wine, where, they've been effectively exporting quality brands or high-value brands. Exporters are also looking at diversifying that and offering potentially lower-grade products in order to offtake that particular price increase. And also from a logistical perspective, also offering smaller packages and sizes in terms of consignments of shipments as well.
And it's not all doom and gloom from what I'm hearing you say. And as South Africa looks to export to other markets, South Africa is not the only country that has been impacted by these tariffs. Other countries have been impacted by these tariffs too. And so, Kobus, I look to you in terms of a question where are we expecting imports, particularly in the automotive industry, to increase as other countries also try to avert these tax tariffs or these tariff hikes from the US?
Thank you, Nompilo. If you'll allow me just to pause before I answer that one, I would like to just respond to something Zahida had said, and maybe thank Zahida for acknowledging how difficult it is to operate as an importer with the currency volatility. And I think she referred to our ability to negotiate with trade partners. That is so important. I think in the OEM space, especially where they are globally listed or global companies, they generally prefer to operate in a hard currency. And although a large volume of our imports in vehicles these days comes from India, and you would think within a BRICS context, the natural response would be, let's go to the Indian rupee, which is more stable, rand rupee cross rate. I think there's a hesitation because of maybe it's either Africa or it's uncertainty or it's just a global answer that they give. But maybe back to your question, Nompilo, I think the answer to are we going to see more brands arriving is an unequivocal yes, semicolon, but I think some of them would have arrived irrespective of tariffs. Why do I say this? I think the South African consumer, if they took the time to walk the high street, they would find that we already have 24 Chinese brands in South Africa. And if you just reverse yourself back to post-COVID, you may have had a handful at most, and some very unknown to the consumer, while today they are well known and well supported, and we saw that again when the NAMSA results came out. I think the South African consumer probably has the widest choice to market size from anywhere, because the barriers to entry are actually quite low. One would think in our industry it would be much higher, and maybe you're thinking because of manufacture, but that's not the case for fully built up units arriving. We also travel longer distances, and anecdotally, I think South Africans are a car-loving country, just in speaking to consumers generally. I think the impact on us in the industry is probably twofold. I think it's a higher investment in our infrastructure, to cater for brands that the consumer requires. So there is a higher cost that we're seeing. We're hoping that the consumer is a winner out of this because of a greater choice that they have. But I think we'll see more and more of that, and the launch of further products, even in the Motus stable through Tata, Indian product, is coming later this month. So yes, I think so.
And I did see a number of cars as I was driving, making my way to work. Zahida, there are a number of South African businesses that are heavily trading with the US. Are we seeing some companies adapting to or adapting their hedging strategies, noting that there is these tariff hikes and also the volatility? Can we see them adapting their hedging strategies?
I think hedging has become a necessity in this type of market. What we see clients doing is moving out of passive hedging to more active hedging. And what that means is that instead of putting on a passive hedge, like a forward exchange contract once off, they look at engaging some of our structured solutions to try and enhance their rates to be able to be more in line with the market. We also see clients rebalancing and restructuring to make sure that they're hedging alongside the market, because, I mean, let's be honest, we all don't have a crystal ball of where it could end up being, and we want to ensure that we stay on top of things as we implement those hedging solutions. And so some of the solutions that clients are looking at that are working quite well in these markets are something called an accumulator forward, which works well for both an exporter as well as an importer. For an importer, it provides a level, actually, Kobus, that's better than where the spot level is at any given point in time for forward dates. And for an exporter, it allows you to set a rate that's better than where the FEC rate is. So an accumulator forward is definitely becoming something that clients are using more broadly. Another very similar product to an FEC that has gained in popularity has been the FEC Plus Wallet, otherwise known in the market as the TARF, a Target Redemption Forward. And what we're seeing is, because of its simplicity, that it acts, looks, feels, and trades like an FEC. The only addition is a target wallet that is set for a period in time, clients are much more comfortable with it. They're much more comfortable with the flexibility that it offers. I mean, each of these hedging solutions are very nuanced to your business. And so I think there needs to be a very deep level of engagement that needs to happen. We need to understand what that competitiveness and the environment is, how you're setting your budget rate, what you're looking to achieve, how, is it a quarterly basis? Is it every 6 months or annually, etc.? And then work alongside you to say, no longer a question of should I hedge, but more importantly, a question of, well, what percentage of my exposure should I actually hedge? How far out should I hedge? And from a timing perspective, that becomes critical. So you can imagine as an importer, you wouldn't want to put hedges on at the all-time high of where the currency is, because that will lock you in for a period of time. So that often that engagement is vital between you and your global markets team.
And we've heard around some of the solutions that are available from a currency perspective. Perhaps to wrap up my conversation with my panelist, Musa, what are some of the trade and working capital solutions that we can offer to these clients, both on the import side? Kobus spoke a lot on the import side, and also on the export side. What are these solutions that we can offer?
Sure, Nompilo. There's a variety of solutions, but similar to the FX solutions that Zahida was speaking about, these solutions will always be applicable depending on your strategy that you're looking at deploying as a company or an exporter. So, for example, we have a financial institutions team with a large global network of banks, which can effectively do country risk assessments on sovereign risk, especially if you are looking at deploying a strategy of going to alternative markets, because that will always be a key in terms of managing sovereign risk and also counterparty risk. If you look at the impact in terms of the cost or the increase in terms of cost of exports going to the US, the natural impact will also be a working capital impact. And there, yet again, in order for us to assist our clients in managing their cash flows, also managing their liquidity whilst they go into different markets, or effectively carry on supplying or exporting to the US, we've got pre-shipment and also post-shipment finance solutions, coupled with solutions such as invoice discounting and export LC discounting to help accelerate liquidity. Beyond that, we've also assisted our clients in terms of risk mitigation solutions, so including export letters of credit and also export credit insurance that we can look at in mitigating that payment risk yet again into the new market. But beyond that, we also have a Standard Bank Trade Club, which provides our exporters with access to a global buyer network. And also, we assist our clients in also doing some DD or due diligence on those potential buyers that they'll be looking at. Now, that just covers the banking solutions and how we can assist, but it goes beyond the banking solutions. If you look at what the DTIC has come out with, where they've effectively also launched the Export Support Desk, which will help some of the companies that are affected, the exporters, with market entry guidance, compliance support, and also from a diplomatic perspective, linkages to embassies and trade missions in various markets. I think some of the other recent proposals that the government has come out with is, for example, the logistics relief fund that they're looking at, and also setting up a fund in terms of export finance, or let's call it infrastructure support, and then also assisting with facilitation of doing intros into new markets, especially for our SMME companies as well.
And thank you for that, Musa. As I wrap up the questions with my awesome panelists, I'm hearing a common trend and a common theme of there are opportunities. It's not doom and gloom. There are strategies that can be implemented by businesses in order to make sure that they're not heavily impacted by these tariff hikes. There are also solutions by government and also solutions by banks and also solutions by the automotive industry and also the agricultural industry to try and assist to cushion these tariff hikes. I will like to hand over over to Justin for some of the questions from our audience. Over to you, Justin.
So we did receive a few questions that I'd like to facilitate with the panel members. So the first question goes to Musa. So Musa, you've mentioned some of the trade solutions which are available. Zahida also did discuss some of the hedging solutions which can be used to mitigate some of the risks that are likely to emanate as a result of companies going into new markets and the like. So I suppose, Musa, first to you. Do you think, as a result of this, these tariffs that have been implemented, that the Treasurer's toolkit now needs to adapt, and that Treasurers, of course, will continue to focus on day-to-day liquidity, but there's additional considerations, and that perhaps the mitigation of payment risk and the mitigation of various market risks are now going to become more relevant to Treasurers during this period?
Yeah, thanks, Justin, for the question. It's a very good question, and fully agree with that particular point. I think if you look at the Treasurer's toolkit, the focus has always been managing balance sheet, income statement, cash flows. But with the new environment that we're trading in, things such as understanding sovereign risk, as I mentioned, is going to become critical as you go into new markets. Things such as understanding and actually bedding down your FX hedging strategy and looking at it from a proactive perspective is going to be also very critical. And then also, as I mentioned, things that you wouldn't naturally look at from a trade finance perspective, things such as credit, export credit insurance is going to play a huge part in terms of considerations when the treasurer actually looks at their particular business as well. So those are the things that I think are going to be more prevalent. Not saying that historically they haven't been there. It's just that with the imposition of these US tariffs, it brings those considerations to the fore.
Perfect. Thanks a lot, Musa. I've got two questions for Kobus. It's just your view around, your outlook for the automotive industry in the context of these tariffs. So if we had to have this conversation in, 3 or 5 years' time, do you think that this will have a lasting impact on the domestic auto industry? Or do you think that the auto industry is resilient and will bounce back and that new markets will be found and that it will have maybe just a passing influence on the market?
Thank you for the question, Justin. I think not to speak on the industry or on the industry's behalf as a whole, I think we have a long history of automotive manufacturing in South Africa. We have a very successful support for the manufacturing through the DTIC, and that has upheld the manufacturing here in South Africa, because every so often, global OEMs need to make a decision as to where they're going to produce. And they have, over time, proven that they are in support of this economy. And thus, I think we have a very good chance to survive these tariffs. That being said, I think maybe that support and how that plays out will remain important in the near future, as OEMs have to make decisions about conversion from traditional ICE vehicles to either hybrid or more so into EV vehicles. And I think that's an interesting and important topic that's getting high on the agenda of the industry body together with government. But I think if you look purely from a consumer perspective, the consumer, and luckily and thankfully through banks such as Standard Bank, are supporting their customers to continue buying our cars, and we will try to support that by providing adequate, affordable opportunity to do so.
Perfect. Thanks a lot, Kobus. For your next question, I'd like us to look maybe less from a macroeconomic or industry perspective, but now look at within individual companies and the role of the relationships that would be in place between, for example, a treasury and procurement, or treasury and the sales team. I would assume that in the context of the challenges that South African companies are now facing, that you'd need to see increased collaboration internally to pivot and adapt business models to basically prosper and create new opportunities in this context. So, Kobus, would you align with that view?
Thank you, Justin. So my previous role as treasurer just led me to better understanding, the various parts of our business and where those pain points are. So there is no doubt in my mind, and I think this is something that treasurers as a profession are driving, is the more strategic role that they have to play within a business. It's not sitting behind a desk, phoning a bank, getting a loan, buying a foreign exchange cover type product, as Zahida mentioned. I think the understanding of the business, the working with the business, understanding the flows more carefully, is part and parcel for the job title today, and I think that's something that's being driven from a board level, and I think that will continue to develop, not only as a result of tariffs, but probably even more so, and especially in the industries that Musa pointed out. In those, it becomes even more important for a treasury activity to not just be hidden in the back room, but to be part of the conversation as it plays out.
Great. No, thanks a lot, Kobus. And then the final question is for Zahida. So Zahida, you've mentioned, that there's a number of different solutions which can be used to mitigate various market risks, interest rate risk, exchange rate risk, commodity price risk, etc., and some very clever structures. So, the first, question that I have for you is around beyond, innovative, bespoke structures. What role and value add do you think that the global markets team can add in assisting our clients? I would think one of the ways would be in providing a free flow of information and providing views on market developments. But I'd just like to get your view on how the global markets team can assist our clients to navigate these challenges that they faced, in addition to these new structures that you can put in place.
Sure. I think, data is critical in this day and age. And so from a global markets perspective, the bank can actually partner with business to provide sort of a view of what you've hedged over a period of time. And that will give you a more closer idea as to what seasonality, timing of the market looks like. You can start to overlay that in terms of your purchases or your sales of foreign currency alongside different periods in currency. And so I think in the Rand market, we are quite comfortable that you don't have any level of seasonality that you might find in other markets, where certain countries might be predominantly an exporter of one agri product, and so then they tend to only have availability of US dollars in that period of time. In the Rand market, we have a diversified economy, and so then you start to overlay, well, what's happening from a currency perspective and alongside some of my trades that I'm doing. And so the global markets team can work quite closely to help you build out those models, to help you stress test different scenarios. So base case, looking at, well, fundamentally, let's put a number to it, 50% base case. This is where we expect the market to be according to our economists. But, there is this tail risk that you have. How do we look at managing that tail risk or mitigating some of the risks in terms of the currency either blowing out either way? And so this then becomes very important discussions to have over and above just solutioning.
Perfect. Thanks a lot, Zahida. And then your final question. So there's been a lot of discussion around volatility in international trade. So we will see changing trade patterns. There's often a lot of views around the currency market, to an extent commodities as well. But I think one of the potential risk factors here is that if there is a sizable increase in tariffs, which are imposed on exports into the US, you could actually see global inflation picking up. And as a result of that, the interest rate outlook might change quite significantly over time as these tariffs actually gain traction. So maybe if you could just provide us with a view around, what companies can do to mitigate their exposure to interest rate risk.
Sure. I think Very pointed question. Thank you, Justin, for that. I think it's very topical at the moment, given that we've just come out of MPC last week. And so our base case view was for there to be just one cut in South African interest rates last week, and then look at managing that over the course of the year. But given what the Reserve Bank governor has said, we're pricing in a second cut come September. And sort of this inflation targeting band has been quite topical. And it's not something that we've seen in the market before in the South African case. I think when the Reserve Bank governor came in, he sort of targeted the middle of the band, that's the 3 to 6%, so the middle of the band being 4.5%. And now that view is completely changed to targeting the lower end of the band. And so then there's this debate going on as, does this sit with Treasury or does this sit with the SARB in terms of managing where that inflation target should end up. And that does definitely change the landscape and predictability of where we expect interest rates to go. And so for a very long time, we almost had a handle on what expected inflation was, what expected GDP was, and hence the outlook of where interest rates are. But when you see volatility and a difficulty in predicting where future interest rates will be and what that differential will be relative to the US dollar, because you've also got that global view that you have to factor in, I think it becomes much more topical then to look at interest rate solutions that you can deploy both in the short term as well as in the long term. So as you have exposure, you might be sitting on sort of, large balances that you need to term out from time to time to try and fix in some interest rates. So that's one side that you could look at, as well as how do you sort of benefit from a declining interest rate cycle, but also making sure that you cap it. If you do see this GDP start to be stagnant and then inflation start to come through, and you almost see a flip in the cycle where what you expect is cutting interest rates and then you go into maybe increasing interest rates, that is a very valid risk at this point in time. And so this level of uncertainty is probably, I wouldn't say unprecedented, but definitely for this time, given what it stems from, which is uncertain economic and trade policy, it is unprecedented.
Thank you very much, Zahida. And that wraps up our Q&A section. So back to you, Nompilo.
Thank you so much, Justin, and thank you to our audience for those wonderful questions. Thank you to my panelists. What an insightful discussion. What a crucial discussion. Today, I come out positive from this discussion. There are new export markets we can look to, supply chain diversification, and also we can leverage the support of government, leverage the support of corporates, and also leverage the support of banks. We look forward to hosting you on our next Standard Bank Trade Table. Thank you so much for joining us. Till next time.